I'd previously released videos on Tesla worrying about the potential for margin compression, but now it's very interesting because Wall Street is now sounding the same alarm. And so that's what I'm going to cover in this video. So as you guys smash that like button, let me run that intro. What's up, guys? And this one's very interesting because a couple of weeks ago when I put out those Tesla videos originally, one of the things that I said was that could we potentially see margin compression as a result of Tesla reducing the price for its vehicles, as they need to reduce those margins just to keep revenue growth going. And, especially as we enter an environment where there's greater competition and Teslas are seen as pretty much like a luxury vehicle in an environment where you have higher interest rates, do they have to make up some of those higher pricing pressures for the consumers by reducing the costs? And I think that all roads lead to an answer that is emphatically yes. But then what does that mean for the ultimate valuation? Well, let's go into what the analysts are now starting to say. So you can see this article came out in Barron's on January 3rd, just a couple of days ago. And so you can see that in my videos that I released on Tesla in December, I spoke about how you shouldn't just be worrying about revenue growth. And I did speak about bringing in revenue growth. And a lot of people got angry at that. Now, you guys who are Tesla bulls are going to get angry at another point because I was also talking about bringing in margins. And now Wall Street is sounding the alarms, I would say. And so here's what they're saying. Wall Street analysts are actually cutting price targets, worried about not only vehicle demand, so that's that revenue part, but profit margins too. And this is the one that I was really interested about because I just didn't see a lot of people sounding the alarm on this when I was doing the research on Tesla just a few weeks ago. So the fact that, things are changing so fast just kind of shows to you what's happening. I think a big part of the talk was just Tesla missing that 50% vehicle delivery mark. But, I think a bigger issue is not, deliveries on the top line. The bigger issue is how profitable are those deliveries that they're actually making. And now we're getting to a point where more and more people are believing that every one of those deliveries are contributing less to the bottom line. And so Citibank wrote that the delivery shortfall relative to expectations isn't entirely shocking. And so what he did say is that COVID issues in China and macroeconomic factors such as rising interest rates would cause sort of like fewer deliveries, partly because, production might slow down and partly because there'd be fewer buyers. So that makes sense. But McKelly sees the share struggling until profit margin visibility improves. And so lower deliveries can mean lower absorption of fixed costs. Now, he's not necessarily talking about contribution margin per vehicle here, but this is where it sort of gets into that. So what's more, Tesla has been offering incentives for delivery, lowering the price taken per sale. So, you first have fewer sales, which obviously reduce profit margins because there's fewer, they're just lower amounts of revenue to cover fixed costs. But then, of course, you have that double whammy because you are now not just selling fewer cars, but you're also making less money on every car sold. So that's exactly what I was saying in those previous videos. So it's very interesting that these analysts are now starting to speak about that. And I will say that I usually don't give myself credit for picking up on these things, but I will give myself a little bit of credit for picking up on the fact that people weren't talking about margins and now all of a sudden it's front and center. And going back to this, JP Morgan analyst Ryan Brinkman reduced his price target for Tesla to $125. So interesting because his price target is not that far from mine, but that's my price target if you don't assume margin compression. Of course, if you assume margin compression, my price target goes down to in the 70s. But he's writing that incentives and discounts suggest lower pricing and margins. So, his lower pricing and margin valuation is $125. So it's very interesting that these price targets come down. And recall, guys, these are 1-year price targets. Now, Cohen's analyst Jeffrey Osborne cut his price target more dramatically than Brinkman, lowering it to $122 per share from $205. And so what he's doing probably, it's that he's taking into account that, he doesn't now believe in that 50% revenue growth rates or even just like higher growth rates in general for deliveries. And of course, he's probably bringing down margins as well. But let's see exactly what he's saying. So he's saying he believes investor focus will shift to that makes sense. So he believes that investor focus will shift to profit margins as the fourth quarter earnings report approaches January 25th. Okay, that makes sense. But why would investors' focus ever not be on profit margin? Can it be on revenue and profit margins? I guess what he's saying is that some of the investors are more just focused on valuing the company from a sort of like price to sales perspective. I get that. But ultimately, we have to think about, the ultimate money that you're going to generate from the security. And so, you have to think about profit margins. And the other issue right now is, and nobody's talking about it yet, but I'll mention it on this channel at least, so I can say that I was early on it, is that as more and more competition floods in, Tesla will also be made to sort of lower their prices to compete with other premium luxury offerings. You've already seen Porsche come out with a great vehicle. You've already seen Volkswagen roll out a line of vehicles. I'm sure the Volkswagens don't compete against the Teslas. I'm sure the Porsche doesn't even compete against the Tesla. Mercedes is coming out with stuff as well. And so the point that I'm making is that the consumer's going to get a lot more choice. And so Tesla will have to compete. And so the economics of competition in the auto business essentially guarantees low margins for everyone, or effectively just doesn't guarantee Tesla to maintain such large margins. So I think that's going to be coming up as well. And I don't think the analysts are talking about it just yet, but that might actually be a 2024 risk, where if you're valuing the company and you're building out an intrinsic value model, which takes into account, as much as you can about the forever risks of the business, that has to be something that you take into account, which is why I'm bringing it up on this channel, because I'm thinking about the next 20 years for Tesla. Albeit I'm probably never going to buy the shares, it still doesn't mean that I can't think about the business from an owner's perspective. Now, the bulls are also cutting their price targets as well. So Goldman Sachs just reduced their price target from 235 to 205. So that's very interesting. And, overall, you're seeing that the average analyst price target for Tesla is now about 260, according to FactSet, which is down from around 290 just a few weeks ago. And that was around when I dropped those Tesla videos. And so in those videos, what I did say is that expect Tesla's price targets by the analysts to come down as the share price remains lower for longer. And so, I called it, and so I'll give myself another pat on the back here. That's unprecedented, 2 pats on the back in one video, but it's going to go lower as well if the share price remains lower for longer, because remember, analysts give 1-year price targets and not intrinsic value price targets. And so you can see that exactly here in action. So in the orange, you have the analyst price targets, and in the blue, you have Tesla's share price. And you can see that in this legend right here. And this is over the past 5 years. Notice how they pretty much are correlated with one another. But the one thing that I will point out is that the share price is a leading indicator of where the analyst price targets are going to go. It's not the other way around. And so if the share price remains around that $100 per share area for longer, of course, the analyst price targets are going to continue to come down. And as you can see, they've come down a lot just in the past little bit. And so once again, these are not intrinsic value price targets. These are 1-year price targets. And the difference is, and I used to be on the sell side, the difference is that with a 1-year price target, you're essentially just forecasting out a metric, whether it be sales, EBITDA, net income, whatever you want to forecast out as the key item to build your valuation upon. And then what you'll do is you'll use sort of like an industry metric. So, whether it be price to earnings, price to sales, whatever, it'll just be some form of multiple. That's generally how everyone does it. And so, if you think that Tesla's going to make X amount of net income next year, you'll just throw a multiple on it. Now, if it's a growth company, you might throw a high multiple on it, because once again, it's a 1-year price target. So you can see how analysts justify throwing like a 45 times earnings price multiple for the next year, because all they're saying is, according to this valuation that we put together, at least on a 1-year time horizon, this is what the company is worth. But as a sort of like a long-term investor who builds intrinsic valuation models, I will take into account the fact that in the early years, you will have those higher multiples, but over the long term, that multiple is going to come down. And so that's why I do like 10-year multiples. So I'm effectively doing the same thing, but I'm just doing it 10 years out, and the multiple is so much lower. And so that's how I'm coming out with my intrinsic value multiple. But you can even do it even differently than that. You can have a model that goes right out for like 100 years and then discount all those cash flows all the way back. I just sort of like circumvent that by just throwing a multiple at the 10-year mark. It inevitably is the same thing, but ultimately what I'm trying to get across to you guys is the intrinsic value sort of valuation takes into account a lot more than what just like a 1-year price target should. In a perfect world, these things should be the same, but in practicality, they're just not. And if you guys want to learn more about this kind of stuff, we have a call every month where I take all of your questions at the upper level of the Patreon. So if you want to join us, please consider joining us. The link is in the description below. But now let's go into our valuation for Tesla. So you can see here that if you don't factor in a margin decline, but you do factor in a revenue decline, which I do do, my model comes out to approximately $96 per share, which, I mean, compared to the current share price at least a couple of days ago, is relatively in line with the current price. And so you could argue that it's fairly valued. However, guys, you know, I do believe that there is going to be margin compression. And so when I take into account margin compression, you can see that my valuation goes down to around $70 per share. Now, I'm very pessimistic on the stock, and so I'm just going to naturally have a lower share price. Now, some of you guys do get angry for me having such a low share price. Just remember, a share price, like the way that I value it, is just an opinion, right? It's not right, it's not wrong, it's just an opinion. If you value the company at something higher, value it at something higher. It's your opinion. And so the point that I'm trying to make is that on this channel, nothing that I say is I state it as fact. You know, like, these are just my opinions. They are not facts. And so I just try to do my best, build out these models, build them out as granularly as possible, and explain sort of like the story behind why I think a company is worth what it is. Feel free to disagree. That's the whole point of being a participant in the market. Now, if you want access to that Tesla model or all the other models that I explained to you guys in the channel, including Alibaba, Alphabet, etc., Starbucks, whatever else, you can get access to all of those models at the lower tier. And once again, I mentioned earlier in this video, if you want to join us this Saturday for a live call, you can join us at that higher tier. Now, the other thing is, all of you guys who are at that lower Patreon, if you want to just join us this month to try the upper tier, just message me in the Patreon and I'll give you a link to join us for free this month, just so that you can trial it and consider if you want to upgrade. Now, guys, I recently put out a video on Apple and why I think that its share price could continue to go down further. And if you've missed that video, no problem. You can get access to that video right here.